So I call it the $1 million people problem. And when I say that, what I mean is, what's the cost of people, losing people specifically? And these are, just a few examples. So Tori was an acquisition entrepreneur. She came from tech, and she discovered during financial diligence, losing one key employee would cost at least $100,000 to replace. That cost could likely be 250,000 if she considers revenues and potential profit loss. We have, John. John is a limited capital partner, um, who limited capital partner of a manufacturing S&B. John, I spoke with him and he said, keeping top talent after the deal protected 1 million in earnings and avoided at least 250,000 in turnover costs. As a limited investor or LP for short, this made all the difference in returns for, general and limited partners. And last but not least, Robert is a current business owner of a tile and marble company. I spoke to Robert and asked him about the $1 million people problem, as I call it, and he said, unfortunately, he learned too late that investing $200,000 to keep my best people would have saved him one, two, or even three times that amount of money in the lost cost of rehiring and earnings. So these three stories from a acquisition entrepreneur, an investor, as well as a business owner highlights, this people problem and really the dollar impact behind it. Jason, anything to add on this?
Yeah, I mean, essentially, just to maybe give an idea of the audience of what I do, I consult and I run my own consulting firm focused on the growth of organizations in the SMB and lower middle market. And one of the platforms I speak on often is people being an important part of the capital side of the business. And this is a story that happens a lot more than is publicized. Oftentimes you'll hear about layoffs, right? Or you'll hear about hiring freezes or things of that nature. But with the audience that we're talking to today, this is something that I see almost on a daily basis when I'm talking to prospects and current customers. And $1 million problem may actually be understated. Sometimes it could be much more than that.
Yeah, and the $1 million price tag is something that, jumps off, but depending on the size of the business, this could be 10 times as big. It could be
Sure.
20 times as big. Um, the point of these real stories from folks in my community was that no one is safe from this people problem, and this needs to be taken seriously. Um,
100%.
so just a couple other, you know, statistics around this. $60,000 was the average cost to replace, one employee. Again, that total impact, very well might be, three times that amount. Um, so this sort of demonstrates the importance around this and why, people should care.
Mhm.
I thought this one was interesting. It was another idea to think about replacement costs, and I'd be curious, and we might be getting ahead of ourselves, Jason. Around 50 to 200% of total salary. So if you are hiring someone or trying to replace $100,000 salary, it might be, 200,000. Like, what do you, when people ask you that question, like, what do you often say?
Sure. So I normally look at it in a couple different areas. So however you want to calculate it, I look at when we're talking about replacement cost of an employee, especially a top performer, there's a few categories you can look at. So you can look at lost revenue, right? That employee generates. You could look at the sunk overhead cost, the cost of replacement, and then potential customer churn, depending on the access that employee has to the customer base. So on average, um, the data that I've looked at is it's 2 to 3 times annual compensation for an employee to replace them, especially when we're specifically talking about top employees. So in your stat, when you look at 50% to 200, 50% may be more like that average level or below average employee. But if you're talking about a top performer, it's 2 to 3x.
Yeah. And I agree with a lot of that sentiment. So, and you started to give a little insight for the people, just tuning in, a little bit about you. Story time, Jason.
Sure. Sure. So I'm the founding and managing partner of Naker Consulting. We're a growth-oriented consulting firm focusing on increasing revenue for our clients through the channels of sales, marketing alignment, customer experience, and leadership. The business is almost a decade old. I'm a product of two entrepreneurial parents. So both of my parents have been owning and operating businesses for the past 5 decades. So I've kind of seen everything from growing up and talking business at the kitchen table to launching my own business and helping others scale theirs. So I've seen a wide range of businesses from Main Street to international businesses. And what I find is a lot of the problems are very similar. It's just the issues copied into a small business, the impact could be more severe versus that being a large corporate conglomerate. But the fact of the matter are there's some very standard problems within business that can create issues both in revenue, margin, and profit. And top performers leaving certainly is a very large issue. So um, I really focus when I consult with companies, and my team does. We believe in human capital being a very important portion of what happens within the business. Dealing with the people and understanding their roles and impact on the business is critical. So we spend a significant amount of time learning, coaching, and consulting in that realm.
Awesome. Appreciate that insight. And sounds like from an early age, you had that sort of entrepreneurial spirit. So,
Yeah, for sure. Yep. My parents were entrepreneurs before it was cool to say you're an entrepreneur like it is today.
it's funny you say that. I always say I was in M&A before it was cool. This whole new wave of SMB. I've been in M&A for over a decade, and it was not the social media darling fueled by Cody Sanchez and Ben Kellys and whatnot. So that's
Yep.
kind of an
Yeah,
interesting kind of evolution of this space. But anyway,
for sure.
so you know the title of the slide. Why do top performers quit after acquisitions, Jason?
So I kind of want to take this and put this on a tilt of like revenue producing top employees. That's where my kind of subject matter expertise normally lies. And I will tell you that there are four main categories, I believe, why they quit. Um, Most of all depend upon change taking place, right? So first and foremost, change in compensation. That's always a big one. Um, Sometimes it could be beneficial, where you're getting paid more money if there's an acquisition that takes place, but change in compensation is always the largest driver of turnover. Then there's change in other things, such as maybe like job description, job duties, job location, work scheduling, right? Maybe remote to in person, things of that nature. Then I believe there's lack of clarity in where the company is going when an acquisition takes place. If the roadmap is not clearly communicated and built out for the existing employees going from the one organization to the new one, that's a huge issue. And then I think one that isn't talked about often, but certainly happens in lower middle market in the SMB is the loss of access to leadership. So when companies change hands through acquisition, you may have a top performer that super close with the CEO, founder of the business. They have lunch together, they golf together, they're really connected, and then that owner, sells and maybe isn't even a part of the new team. that loss and lack of access to the new leaders of the organization, it creates doubt and worth within the top performer. So they look to go find that someplace else. Patrick, you're on mute, I think.
Okay. Thank you. So the access to leadership is interesting. That's an interesting angle. How does, what does that look like in like the real like acquisitions, like post close? Is it really just absentee? Like what have you seen?
So it's a couple things. When you're a top performer, you have access and you have a voice. So that voice, like basically, if you're loud about something not going right, or you don't like the direction of something, top performers normally have that access and they have that ability to share that. So when that changes post acquisition, um, the top performer may just internally not feel like they have the ability or the clout to communicate their feelings on what they think is right or what they think is wrong because they're maybe more concerned about their position. Or it could just be the people that are really running the company are no longer physically in the ecosystem that that top performer has operated in, so that they just feel like they're kind of on their own island. So there's a number of different ways depending on what type of company you're talking about, but that's normally what I see.
Gotcha. Yeah, and that's something that I see in the change of ownership, is that value piece, which is hard to transfer over, especially when in acquisitions or any kind of sale or change of ownership. I call it it's like the trust test. The high performing employees don't trust the new owner as much as, they probably should, if they have good values, etc. So it's definitely something very apparent.
For sure. And I think one more point on that too is um, I've seen this done very well and I've seen it done very poorly. But when you have the acquisition team comes in, um, a lot of times these are really highly skilled people that have done this time and time and time again. So they're so polished and their polish almost comes across as like being fake. And I think employees really sniff that out when there's that dinner with the acquisition team or the new leadership or that form of communication. A lot of the right things and the right words are said, but I think a lot of the existing top performer employees, they're making their own determination of whether or not they're going to trust those people or not. And that happens in kind of almost first impression type of situations.
Yeah, I agree. So when you're having some of those conversations, what's one piece of advice for those looking, to buy a business, and when they specifically are trying to understand like what's the personnel I'm buying? Like, any tips?
Yeah, I have a number of them. I think the first and foremost, again, if we're thinking through the lens of revenue producing employees or people that are maybe managing or overseeing large revenue silos of the business, you need to understand the customer concentration in relation to revenue and then the access that those top performers have to the customers that have the highest concentration of revenue. So you kind of have to determine very quickly where your opportunities of risk are. And you need to understand very quickly whether or not that top performer staying or going would put that at risk. And it's a very difficult dance because most times the acquiring company is not going to have access to the employees to have conversations with them. They may have access to a leadership team, so they're going to have to take the leadership team's word for it. But one of the things that I've done, because I've worked for private equity, often they'll bring me in after they make an acquisition. I actually created a product to do like human capital due diligence, not on like the recruiting side of things, but I will go in and say, if available, let me talk to some of the top performers in the revenue stack and let me have conversations with them, and I'll give you my opinion of where there may be risk components throughout the acquisition so that you can properly evaluate and value what that risk is when you're putting numbers to it.
Yeah, that's an interesting idea. And there's so much emphasis on valuation and the price you pay. The human capital piece is often overlooked. So how do, I guess, how do you, without articulating, statistics, what's the sales pitch for people who may gloss over this kind of, what's the risk of this?
So the risk is your revenue, your revenue and your exit model not, not tying out in the 3 or 5 or 7 year horizon. And I think that oftentimes, and you understand this, and the diligence and the financial diligence and the revenue diligence needs to be done, and it's often done from a spreadsheet format, and it's looking at data analysis and going from there. And I think that what probably needs to happen is there needs to be more of an emphasis after that financial diligence of what type of delta do we have with human capital, right? What could be something that we could build in that would account for maybe something not going exactly the way we think it's going to go in diligence, right? Or after diligence. So I think that if you're not able to if you're not able to have the conversations with the rainmakers or the really important top performers, I think you have to dig into the financial diligence and the revenue diligence and see where the errors may or the issues may be and the risk is, and then create some form of a modification on your value for that, just to account for those things.
Yeah, I agree with all points. So when you kind of speak with business owners, how can you help get them on board?
The business owners like post acquisition.
Yes, the new business owners, or if you maybe a friend or someone who's dealing with this issue, like what's like some how can you help change this? And
Sure. So I think it comes down to asking a lot of questions about the business, like the mix of employees, you know, your customer concentration, where it's at, your largest customer, like what are your I often say, who are your top 5 or top 10 customers and how much revenue on an annual basis are they generating for you? And through that process, I'll just very clearly point out, okay, it looks like you've got a really balanced mix. And although they're your top 10, they're not taking up a large percentage of your overall revenue. But if there is some significant risk there, like I will basically just kind of clearly call it out and say, what plans do you have? Like if this customer was to leave, how would you look to replace that? Or how long do you think it would take for you to replace, you know, a few of these top customers leaving if you had any turnover, if they didn't like the new acquisition team, like, and what would that do to the 3 or 5 year plan of the business if there's an exit after that? So I just kind of ask a lot of questions to see the mindset of the business owner or the new acquisition team. And then depending on how they respond is where I'll kind of start to dial into, more of the details around it. And where I think there's a significant amount of danger, and this is very common, is if somebody purchases a company and, let's say like the CRO or the VP of sales that is maybe a bag carrying VP of sales, meaning they're a producing sales manager. They're like number 2, number 3 employee within the organization when it started, and they have a significant impact and influence on the company. I'll ask direct questions around how's that relationship going? Have you had one-on-one conversations with them? Have you met? Have you spent any time building a relationship with he or she? Because I would imagine they have significant impact on your post-acquisition business. So I'll start to try to identify who those people are and ask them questions and see where their headspace is. And if they've done those things, obviously I'll commend them on that. But if they don't, I have a slew of stories that I could share with them why they should be doing something separate.
yeah, so if there's a pushback, what's a story you'll go to for an example? And
Sure, sure. So I have an example of a client that I worked with that did very well, had strong EBITDA numbers, and it was purchased by private equity. Private equity came in. They knew that they could create a cash infusion and really start to um, make the company do a lot better and bring new customers to the organization. Part of the problem was that happened is that the organization was used to selling a product that was a kind of a mid-level product from a cost perspective, and the private equity company wanted to take it to an enterprise sale, and they brought in heavy hitters to do that, and then the ops side of the house broke down, right? So what in this specific situation that happened is post acquisition, they engaged a recruiting firm to find these two highly talented reps that could bring a book of business in. So they paid a recruiter to do that. They bring these reps in, pay them high salary. They start to access their book of business and look to acquire some of these customers. As they are acquiring these customers, they're much higher in scope and in effort and in execution than what the previous business was used to doing. And the operations side basically broke down. And not only did they lose the customers, but the sales employees lost face with their book of business. And then ultimately, within 12 months, both of them left. So one of the things that happens is when you think about what we talked about is what is the real cost? Well, you think about the cost, the reputational cost, and that is kind of difficult to quantify, but there's a reputational cost there. Then there's the cost, hard cost of using a recruiter to find these folks, the sunk cost of the overhead you've already paid, and then the cost of the operational inefficiencies that took place that hurt a cascading group of clients. So I would say in that very specific example, that was $1 million problem when it was all said and done. And when you're dealing with a 20 or $25 million company, like that's a pretty significant hit to the bottom line. So that's just one of the stories that I would tell and I would caution them on. Because being a growth consultant, everybody wants to grow, everybody wants to scale, everybody wants it faster, sooner, than sometimes what is really, really, truly going to happen. So I don't try to undershoot expectations. I just try to right size expectations and say what is generally appropriate and what isn't.
Yeah, it's interesting. So if we go back to the example, it sounds like the executive recruiters who are paid a hefty fee, was it a function of them finding the wrong people? Or I guess what did that look like?
No, actually, in this situation, and they the recruiter in this type of situation actually did exactly what they were asked to do and to bring in. And throughout that process, and kudos to the recruiting firm that did it, they very specifically brought up the question of like, will these people be able to take uh, will we be able to take this book of business from this profile of kind of like the sales killer, and will they be able to translate that on the ops side? Like, are we set up to scale? And the answers were yes, 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 we're set up to scale, and it just execution wise didn't work out. So there was diligence and there was some thorough process done. There was just a probably an assumption that it would be easier to do than it actually was. And from a top performer standpoint, if you look at the top performer issues on the ops side, that created major issues because they were kind of handed a bunch of business that they weren't used to working on and couldn't do.
Interesting. Okay, that's helpful. I know I'm just, as you know, for those of you tuning in, diving on, the real cost of compensation and losing, some key employees in small businesses. So I appreciate real examples. We did have one question come through which said, how do you think about comp changes post closing?
So there's a couple things that I would say about that. Sometimes it's necessary, right? So there are I've been in the business of looking at comp plans and working with sales teams for 24 years. I have seen some wild comp plans, right? Wildly too aggressive and wildly pro business where the salespeople weren't getting paid anything. I think if you find yourself in one of those situations where it just can't stay the way it is because it's that bad, then you have to change it because that's just the right thing to do and fiscally responsible for the acquiring business. But if it's not egregious, I suggest waiting in a period of time to really adjust to the business once you are the owner of that business. Like even if it's as short as 90 days, get in there, understand what's going on, see the real world example of this is what was sold, this is what's paid out in comp, these are what our margins were. Does this make sense for our model or does it not? I think even 90 days makes sense to wait, but I think 6 months is probably even better to build that trust again, unless it's an egregious plan.
Yeah, and it's interesting, and this comes up. I'm part of a monthly meetup of business owners, people who want to buy businesses, and some acquisition entrepreneurs speak to this problem. And someone said that, you know, they took the road of they agreed to one employee's compensation request, I think on day 10. And
Okay.
then all of a sudden, five more came within 30 days. So it sounds like the benchmark is 90 days. Is that fair to say, or what do you think?
I mean, I think at least 90 is a good benchmark for you to have a quarter worth of data to see what was, what are all the like, dot your I's, cross your T's. What was sold? What was the cost of the sale? Right? What's paid out on the back end? What's the margin of that product? And really understanding because oftentimes when you're acquiring a business, one of the things, especially if it's in that SMB world, a lot of times the financials may not be as robust as you'd like them to be. So you kind of need in post acquisition, you need your financial team to really dig into the numbers to understand what's what. So unless you have extreme amount of confidence in the diligence side, that 90 days gives your financial team enough time to really dig into the details.
Yep. And I think it makes sense. And it's definitely, are there certain industries this works well in, or like, or is it kind of just a blanket playbook?
So I think it depends on the industry for sure. I mean, if you're talking B2B SaaS, it's going to be different than manufacturing, right? I think sales cycle matters. So if you're in a long enterprise sale, making a change now may not affect the employee for a year because it could be a 6 to 12 month sales process. But if you're dealing with a 30-day opportunity to close sales cycle or a 60-day, you could have a pipeline that's filled with millions of dollars. And if you make a comp plan change, day one, you could have those people looking at it saying, all right, well, what I put in the pipeline a month ago is now I'm only going to get paid out X% of what I would have been paid. So I think it really depends on the sales cycle. And um, I believe in there's certain standards in business that I think are uniform, but when it comes to compensation planning, I really do believe that compensation planning should be custom to the business, associated with their goals for both growth and margin.
Gotcha. Yeah, I agree. I'm asked a lot around industry specifics and a lot of the methodologies, it depends on the people you're dealing with. And I think that's more of what your assessment is, like heading into an acquisition or like after you've done diligence, um, to apply kind of that best
Sure.
practice. So appreciate, that question, Tom. If others, have questions for Jason and I, feel free to throw them in the chat and we'll try to get to them, as best as possible. We're going to skip the real cost unless you have other things you want to hammer in, Jason.
No, the one thing I'll say is on one of your previous um, webinars, you spoke with Cal and he was talking about revenue per employee. And I do believe that is a really important metric for acquiring businesses to understand. And it's something that once you feel confident in that metric, it does tell a story about how you can grow and what the impediments are to growth when it comes there. So I do think that's something that is a metric to track as well.
Yeah. Kale's an exceptional entrepreneur, as you know, and he was very focused on revenue by employee. I guess I always use, analysis paralysis is real. Is that something, is that a worthwhile thing everyone should be doing? What do you think about that?
I mean, I really think it depends upon what the acquiring company's goals are for the scale of the business. Because there are some companies, I mean, everybody wants EBITDA numbers to be strong, right? Everybody wants that. But there are some that say we're okay with a flat year if we add this, or we're okay with keeping things the way they were as long as we can keep adding more on the top line because it's going to work itself out in a year or two as we continue to add into the business. So I do really think it depends upon the thesis of the acquiring business and how fast or the timing at which they want to scale and which they want to exit.
Yeah, that's fair. Um, Another question came in, says most self-funded deals, so self-funded search deals, think smaller acquisitions, don't have robust sales teams. A lot of owners worry more about the number two leaving. What are 3 to 4 best practices for handling that risk week one?
So if there's a number two, let's assume that the number two, if they've been, and I've seen it a lot where the number two is communicated with fairly often in that purchase process and in that diligence process. If that's the case, I mean, one of the best practices is give them skin in the game. Like look at some form of equity, agreement or some type of earn in or something like that, or warrants or anything that gives them connection to stay with the business and want to grow within the business. So however that is done and whatever makes sense for the acquiring business, you have to you have to display and show the value that you see in that number two so that they can feel that and know that they have a vested interest in where the company continues to go. So, um, going back to what I said earlier, though, M. Fisher's asking about 3 to 4 best practices. I think number one, first and foremost, always is if you can give them skin in the game, give them skin in the game. Um, but secondly, I think it comes down to meeting with that person and having a very direct, clear communication line with that person and make sure that you're looking them in the eye and understand what they want. Ask them questions. What are you looking for out of this? Like, how long do you want to be here? What are your goals? What's going to excite you within the business and things of that nature? And I think I've always found that having direct and honest and real, transparent conversations with people tells you a lot. Um, like so for example, if you're an acquiring business and you say, listen, we're gonna try to put this on overdrive, which means that there may be a little more effort and time needed to focus on this, but we are certainly going to compensate you, for that, especially when you sell and we're going to do X, Y, and Z. If you have that conversation, they're like, well, I'm not really motivated by money and that's not something that really interests me. Well, now you have a risk on your hands. But if they light up and they're really excited about it, then you should, you lean into that. And that's where you then couple and say, do we need to, as the acquiring company, do we need to change a comp plan to really excite this person and keep them motivated to run as fast as we want them to run to be able to impact the business?
Yeah, and this idea of compensation and skin in the game is talked about a lot because it does move the needle. There also, the other side of the coin is that some people just want to get paid. Like they don't have that entrepreneurial hustle, um, which is fair. People are different. They have short-term, long-term goals, etc. What and this answers, to Sarah's question. Thank you very much to keep, for those of you continuing to throw messages in the chat. What are typical profit share equity agreements for that number two?
So I know this specific question was on the COO type. I'm less, I have less experience dealing with the COO compensation as I do as like a CRO or, on the VP of sales side. But let's say on average, for that small business size, you're talking like a 0.5% to 1.5%, um, from an equity standpoint in that range for that number two, dependent upon business size and things of that nature. But I've seen it often happen where like there's a 0.5% or 0.75% given, and then there's earn in for the other 0.75% or percent with some cascading bonuses attached to that as well. I'm a big fan of mix of cash and equity. I think it helps both sides. 10 years ago, I feel like people loved the equity play, and they didn't care about cash because like, oh, this is great. But over the last decade, people understand that the experience is like sometimes you get equity, it can be nothing,
Yeah.
right? Depending on if the company's not going to exit or if there's not an event in the future. So I like incentivizing in a mix of equity and cash being in the form of bonuses. And I think oftentimes it is great to do the mix of cash both on individual performance and company performance. Because through my lens, when you look at revenue production, there's a lot of times where you could have a top performer and they're getting paid on top line. So it's like they don't care if we discounted the deal 50% to get it. They don't care about the margin. They just want to sell and get their X% of commission. And that's how they roll. But that's probably not great for the business. So it's like you can use that mix of both cash and equity in forms of bonus, or revenue achievements to be able to fully compensate and motivate those people.
Yeah, and there's certainly not a one size fits all in this idea. One topic I want double clicking on is that idea of top line revenue metrics tied to sales bonuses or sales compensation. This is talked about a lot on SMBX in the service space or businesses that have razor thin margins or not even razor thin, but 10, 15%. The challenge is you tie it based on top line revenue and you sell business that loses money. So you're not only losing money or barely breaking even, you also have to pay that additional compensation.
Sure.
I think that's actually a great point. For those of you, I imagine for some of them who joined, they're looking at these service businesses. So I think that's something that you should consider as you kind of think about
Yeah,
that.
you definitely should. And I think that one of the ways to do that is to understand your, customer acquisition costs, right? And then understanding what the margin is on each one of your products. Because oftentimes what people do, especially on the small side, is they'll say, okay, like our top line's here, our net profits here, here's our margins, and everything's great. And it's like, well, that's not necessarily the case because if you're selling multiple products, your cost of acquisition could be higher in certain products than others. And if you're paying everything just lumped in together, you certainly have a significant amount of danger. I think you and I are both connected to Jonah on X, and he talks a lot about how important it is to compensate based on pay compensation and commission specifically based on margin and ensuring that you're looking at how profitable each product is and making sure you adjust your commissions on that. And I think for the smaller the business is and the more risk you have there, you certainly have to understand what that looks like.
Yeah, and so many good nuggets and tangents we could take away. The last piece was how do you think about capping out? So I guess the fear is if you have an uncapped profit, they just run wild and then maybe they leave after that year. So how do you think about capping?
In a general sense, I think that any salesperson that has a capped commission plan, they don't like it. So I always, when I build compensation plans, I love the concept of tiered compensation as revenue or sales increases, tied to monthly goals and quarterly goals with a monthly commission and quarterly bonus attached to um, percentage of goal. Because what you don't want is you don't want your team to sandbag. Sandbagging is something that happens in a lot of companies, especially with very experienced salespeople. And I have a lot of friends that are high-end salespeople, and they're probably going to shoot me text and hate me for saying it, but they understand how to play the game and how to sandbag. And if we're talking specifically to business owners and those acquiring businesses, that will kill your profitability when people sandbag based on their compensation. So a way to remove that is you pay more to get people to run through the tape on a monthly, quarterly, and annual basis, and that's how you do it. I'm also not a huge fan of paying the same amount of commission rate for existing customer base as opposed to new customers. So there's a mix there as well. So depending on how it's set up, if you're a rep and you're managing a book of business, I'd like to compensate higher for new business through the door.
So new business, higher compensation.
Correct. Yeah. And then ultimately, to put a bow on the question you asked me, is I often do not cap commission, but before we put a commission plan in place, we understand and build out the scenarios of what happens if, you know, Jane Smith, the enterprise rep, who's normally selling $1 million a year or $2 million a year, sells five. What is this going to look like? And based on them bringing in 5 million, what's the cash collected, and can we afford this?
Yeah, and I think that's fair because ultimately the business has to make profit for these commissions to even be available. So I think again, so many good nuggets. I like the idea of the new customers versus like existing. Um, I guess with selling existing, would those be some that churned? I guess it might be a specific question, but I think about like a customer you used to have, they go back to them. Would you give them credit for that new customer again? Or like, what does that look like?
And again, it all depends, but normally there's kind of dormant customers, and then there's like former customers. And I think if you put a month range on that, like you could say, depending on how often people order whatever product you're selling, that's where you would figure out what that monthly mix would be. But let's say somebody that hasn't ordered in 6 to 18 months is dormant, and then post 18 months is they're like not a customer anymore. So if you were to get them to come back, you can pay them as a new customer brought back in the door, but you would also want to pay attention to what does our former customer list look like, and what happens if, have they been worked before and they're just not coming, and this new person comes in and they're able to make them current again. Well, then they deserve that new customer payment. But if it's, there's always ways to game the system, so you have to think about that before you put it in place.
Yeah, I think, and I agree with all of those kind of nuggets. So appreciate those questions. And I guess one last point about the compensation structure. Do you, as I think about my own business and compensation structures and, your own consulting, do you ever kind of bounce off like your network about compensation structures or like, because these things it's kind of like a gray area of business. I know if I had to, when I do it, I speak to my brothers and friends to talk through it. What does that look like for you personally?
So I I do have, I mean, I'm always open to outside perspective and learning from other people. Again, I've built hundreds of comp plans myself throughout the course of my career. Um, and through what I do consulting, I see so many different forms of compensation that I've seen a wide range. And it's one of the first things I ask about when I talk with a company that wants to grow. I'll ask them about their compensation plan and how they have it set up and why they arrived at that. And there's two types of people normally. They have defensive comp plans and they have aggressive comp plans, right? There's that's like the 80%, and then there's the 20% that is either so terrible or they're like they get it, they're hitting the sweet spot, they understand what motivates people, and then they make that happen. I mean, I just spoke with a business owner the other day that I did some consulting for, that is scaling at a pretty quick clip, but small business, only 2 years old, and they're probably going to do 3 million bucks this year. And their number one salesperson ever on the team has a really aggressive comp plan that is going to be really difficult to scale long term. And it's going to be a really hard conversation because that person is now used to making a significant amount of money in compensation, but there's just no way it's scalable. And there's really nothing you can do about it now because what's done and what's happened is happened. But you do have to have a direct question and say like, hey, like we're gonna have to change this. And there are some reasons that I helped consult with this business owner on why and how to have that conversation. But yeah, it can be dangerous if you pay people the wrong way because that's what they expect. And then once you change and start messing with their money, they get a little upset.
Yeah, it's funny every time, and I don't come from a sales background. I am a numbers nerd, Excel nerd, an accounting nerd. Every time I think of this idea of like the salesman making more, I just revert back to The Office, where Michael Scott realized like the paper salesman, like Dwight and Jim, were making more money than him on like a year. So how do you handle like these, you know, if a business owner says, or if someone bought a business and they realize the legacy owner has this crazy high compensation plan with one of their employees, is it a function of probably going to churn them just to changing it? Like, how do you have you handled something like that at all?
Yeah, I mean, I think what it comes down to is really understanding, and this is where I think I approach things differently. I always ask the owner or the acquiring company, like, tell me about your goals. Like, what is your thesis? Where are you going with this? And what is ideal outcomes for you over the course of the next year to 5 years? Like, what are you really looking for in this business? And based upon what they're trying to achieve, then we start working backwards and saying, all right, well, does this comp plan help you or hurt you achieve that? Right? Where are the issues or the errors in this that are going to cause friction or speed issues or whatever the case may be? So I normally stop before I say, oh, this is a bad plan or this is a good plan. I'll say, tell me about where you're going. What are your goals and what do you want out of this company this year or no, over the course of the next 3 to 5 years? And then I'll say like compensation planning, you don't have to set a plan and have it be in place for 5 years. It can adjust. You have to be considerate. You have to be aware of how it adjusts, but every year there should be adjustments. I mean, we live in a world filled with different tariffs and different costs and things of that nature. And, what was maybe a 30% profit margin product last year could be a 10% profit margin product this year. And there are widespread issues that that are a result of that, but reality is reality. And you just have to be open and honest and have those good conversations. But you also have to be willing to, if you want to keep top talent, you also have to be willing to pay them well. So if you do have somebody that is an absolute rainmaker and they make more than the CEO, that's okay. I fully believe that because normally that top talent, that rainmaker, they don't have back end equity in the business. They're just a rainmaker. Um, and if they have both, then that's awesome too. But that keeps them more connected to wanting to make it rain.
Yeah, I mean, still looking for my rainmaker. One day we'll get there. So is best practice like an annual review of these plans?
Yes, I mean so their best practice, yes, annual review, but again, dependent upon the size of the organization, the cost of sales and the cost of this people producing the sales needs to be reviewed by the financial team, and whether it's an outside financial team, CPA, bookkeeper, whatever it is, I do think that is something that should be looked upon more than once a year. But normally what I do is if there's a plan in place and I talk to a customer, um, I'll say like, by the end of third quarter, going into early fourth quarter, like we should do some evaluation on the comp plan in the business, and then let's be prepared to deliver a comp plan at the end of the year or by week one of the new year, as opposed to waiting and saying, oh, we're going to change your comp plan, but we're not going to really do anything until the end of the quarter or whatever. Like there's some people that just get kind of distracted and or lazy towards the end of the year. But I do really believe that this is something that should be done, you know, 90 days before the year ends or when you want to make the adjustments.
I agree. A lot of good takeaways. I think as we approach the hour, for those of you joining and want to learn more, I'm going to be with Ben on how to elevate a brand's marketing retention. It's a webinar going to be held a little bit later this month. If you want to scan the QR code to register, Ben and I are going to dive into how to elevate, the retention marketing before you buy a company. The smart buyer's edge. Ben's a wealth of knowledge, so feel free to scan the QR code to register. All participants will receive a free copy of the recording, as well as any templates he has in his Rolodex. So looking forward to seeing you there. Um, so Jason, in closing, what's the number one takeaway? We kind of beat compensation. Like, what is one thing people can take from this?
I think if you're a business owner or you're an acquiring team that's looking to purchase a business, I think you have to focus on who are the top performers in the business and identify any risk associated with those top performers. And it's not just risk. I think it's committing to assigning either people on your team, or if you're a single acquirer, um, time and scope to spend time with those top performers to understand who they are and what they're all about, because they are opportunities of growth or significant opportunities of risk.
I love that. I think that's a good closing.
And I'll say one more thing. Like, this
Yeah,
is something that I've been saying a lot, but delayed pain is the worst type of pain. So don't get enamored with the acquisition and like say, oh, I'll deal with this potential issue in the future. Delayed pain always costs more.
I agree. So really appreciate you joining and giving so many good nuggets. If you want, we'll pause now for some questions. Appreciate everyone kind of joining. If you have a few more minutes, we'd love to connect with you. Otherwise, feel free to reach out to, most importantly, Jason, on LinkedIn or, his channels. Where can people find you, Jason?
Yeah, so LinkedIn, obviously my website, nakerconsulting.com. X, I'm pretty active on X. My handle's at Jason M. Pearl, and super active there as well. So I'd say X and LinkedIn socially is where you can find me. And then my website is how you can connect with me.
Awesome. So with that, I'll pause for about a minute or two for, any last questions. And Yeah. Otherwise, we'll see you on the next one. So we'll see. We'll hold for about a minute for questions.
Somebody also put in the comments there the importance of sales plans being drafted annually for both targets and commissions. And I think that's an important thing that we really didn't touch on, is that comp plans are obviously associated with the goals that are put in place, and the targets that are put in place. And I think that every year it's an important exercise to understand internally and externally with the business, and then setting appropriate goals. And appropriate goals shouldn't just be a copy and paste from the previous year with like a percentage increase. It should take into consideration those internal and external changes so that everybody can create buy-in with it. Because the worst thing to happen with a comp plan is when salespeople think it's overly aggressive or they think it's going to be super easy, they act accordingly. And you want it to push them, but you also want it to be within reach. And when you set an appropriate comp plan, you're not losing your shirt as an employer when people hit their quotas. Um, they should make a lot of money when they significantly exceed their quotas, but significantly exceeding is 20, 30 plus percent, not they hit 102% of their plan and they're patting themselves on the back, because although we're happy that they hit their goal, it's not you know they shouldn't be overcompensated for that.
Yeah. So how do you think about, as a business owner, like check-ins, with some of your high performers? What's your best practice?
One-on-ones are critical. Even if it's a 15-minute check-in, Um, Weekly is difficult depending upon how many people you have on your team. But if it's a small team, you could do a weekly 30-minute check-in and say, hey, if we don't need 30 minutes, we'll jump at minute 12. It doesn't matter. It's just a standard expectation. And in that one-on-one check-in, it does two things. You as the owner, it gives you the opportunity to make that top employee feel like they're worth your time on a weekly basis, but also it gives you an opportunity to have them show up prepared to discuss business with you on a weekly basis. And it shouldn't just be you as the manager or owner or leader leading the one-on-one. It's you're both coming prepared to discuss certain things, and that should be communicated properly.
Yeah. And what I do in my own business is some more accountability, and I probably have just stolen it from other great, business owners where the expectations are on like a weekly basis and they put together like an agenda of like things they want to cover. So
Mhm.
it's not like a top down. When I first founded my first business, I was doing a lot more talking and not enough listening. So I've found giving them ownership and forcing them to put pen to paper of like what they want to achieve has yielded significant results.
Yeah, because most leaders they stop doing one-on-ones because it's too cumbersome of time for them to prepare and be ready for it. Where I believe that you should have the employee come prepared for the one-on-one. They should be designing 80% of the agenda, and you are speaking to the 20% that they need help with. You are there to help unlock them be more effective than just them report to you what they're doing. That could be done in an email, that could be done on a spreadsheet, should probably be done in a CRM, but yeah, it's not for just like tell me what you've been doing.
Yeah, it's interesting. You might not know. Do you use like a framework or like a template or just like a Google Doc? Like, what does that look like if we,
Yeah, so normally it's for me personally, it's just a doc that I use with my team, and I've got a small team. But when I coach to it, there's a couple different platforms I've used in the past. 15.5 was a pretty good platform for that. It's a software platform that I used with a client a couple years ago, and you can structure one-on-ones, and they basically your employees get reminded to fill it out like 24 hours beforehand, and then they get reminded again a few hours before the meeting, and it comes to you as the leader and you see all the things that are working, their wins, the things they want your help with, and then you come in prepared for that meeting to talk about those things. So there's a number of different software platforms that are out there, but don't let buying a platform be the reason you don't have a one-on-one. You could very easily put it on a shared Google Doc or SharePoint doc within Microsoft, anything like that.
Yeah, I just use like a running pageless Google Doc right now. It's probably not the best thing, but it's something that's worked for me. As you think about scaling, and my team is very small. Like, when do you think about bringing on like that middle management, I guess? And that's more, we're going off topic, but I'm just kind of curious how you think about that.
So I normally think that if you look through the lens of a small business like the SMB, cost is always prohibitive, right? So everyone's always worried about cost, which normally means that you wait too long to bring in someone else to burden the labor that you need them to burden. So I normally see people wait too long. I think that if you can invest, even if you feel it a little bit, it's worth the investment so that you can scale. Because as the business owner, you have to shed and delegate more, and not do it all. You could do that up to a couple $1 million, but you're going to be working like crazy, and you're going to at some point in time burn out and hate your life. Pay the people, pay good people, hire for people that have skills that you don't have, and you will find that you will succeed a heck of a lot quicker.
Yeah, it's a challenge that I struggle with, and we've talked about this, on our other discussions.
Mhm.
Should your, where, how do you vet and try to find some of these top performers? Like, what are qualities you look for in
So great
top
question.
sales performers specifically?
So I look very specifically for people that are self-starters and have been able to take something out of very little, and have a track record of that. So I'm probably the annoying interviewer that asks about like what their first job was and how long they've been working and like what do they love about what they do and how do they think about what success is? How do they create personal goals? I ask them about their personal life. I try to understand holistically who the people are because that helps you understand what makes them tick. So people that started working early in life, people that like to coach or like to get involved in extracurriculars, like there are intangibles that make top performers really stick out. um, and there are others that could look like they're top performers, but there's always a story as to why they didn't get to that next level, right? So it's like that's what I'll key in a lot too. It's like, well, I was doing really well here. I got here. Like I just did some interviews for a client of mine, and somebody said, "Yeah, I'm number three on the sales team." I was like, "Okay, well, tell me how far away you are from number two, how far away are you from number one, and how many people are on your sales team?" I'm like, and they started kind of like thinking, and then they started just kind of going down the side of, well, there's five on the team, but I'm number three because of this. And I'm not quite sure exactly how far away I am from number two. And number one's been there for 15 years. So I can't compete with number one. And it's like, okay, that's not the mind frame that I'm looking for, certainly in a production.
Yeah, that's true. There are intangibles as I think about how I hire people and select that I probably should add more emphasis on. I think a lot of people, rightfully so, are looking for like a good fit. Like, can they do the technical matter job that I need? Um, so it's interesting. I think that's a valuable point.
Right?
Cool. Well, we are past the hour, so I'm gonna uh, end today's session. Again, if you have more questions, feel free to reach out to Jason or I on LinkedIn, X, both of our respective websites. Otherwise, Jason, thank you so much for joining. I had a great conversation. Appreciate it.
Appreciate you, Patrick. Thanks, everybody. Have a great
All right.
day.
Take care. See you guys next time.